This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky. In this video, we're going to do a deep dive into Disney, who just reported their Q3 2022 earnings, and it was absolutely dismal.
Well, that was a disaster.
They were off over 13% in one day, and their stock price is now down to $91.96, which is right about where it was during the pandemic lows in March of 2020. Just because the stock is down big doesn't necessarily mean it is cheap. It could be that the underlying business itself has eroded to the point where the stock could still be overvalued. So the question for Disney investors or potential Disney investors is, what is the future outlook of the business? Has it changed at a fundamental level? And more importantly, does the stock price today reflect an overly bearish or even bullish outlook? In today's video, we're going to look at the reasons why Disney has struggled so much both this year and in past years. We're going to do a deep dive into the financial statements to see which segments are weighing it down. We're also going to look at the widely covered direct-to-consumer division and take a look at a few levers that Disney could pull to make that division profitable. And then at the end of the video, I'm going to do a valuation estimate. If we could sum up Disney's woes in two problems, the first problem would be COVID-19. It's difficult to overstate how much of an impact COVID has had on Disney's business. If you look at their 2021 10K annual report, they say the word COVID-19 113 times. Clearly, this has had a huge impact on their business, and that is most acutely felt in the parks division. Here's a snapshot of Disney's 2021 annual report, and you can see that they break their revenues and operating income into basically two divisions. There's the Disney Media and Entertainment, which is what you see when you go to the movies, and the Disney Plus, ESPN, things like that. And then there's the Disney Parks, Experiences, and Products. So you visit a park, you buy food, you stay at the hotel, you buy a little trinket for your son or daughter or whoever. This is the division that's clearly been hit hardest by COVID. You can see that back in 2019, before the pandemic, the Disney Parks, Experiences, and Products generated revenue of $26.8 billion. During the partially open 2020 season, you see that those revenues dropped substantially by nearly $10 billion. And as a result, the operating income of that particular division, which is shown right here, went from $7.3 billion in profits in 2019 to $455 million in 2020. And those problems have extended even through 2021, when that division made only $471 million. Fortunately for Disney, and really for all of us, COVID has been largely put behind us. So the parks revenue should increase back to what we saw in 2019. At minimum, it should start to trend in a pretty healthy direction. And you can already start to see that in the last quarter's results. The parks are starting to come back online and generate substantially more operating income than they were in 2020 and 2021. And that alone should add a substantial amount to Disney's earnings, which we'll see here in a few minutes. But the second problem, and the one that's getting the most headlines by far, is the media transformation. Disney used to be, and still is, in the business of basically licensing their particular networks, content, that sort of thing, to cable subscribers, right? So you would have a subscription to Dish Network or Comcast or whatever, and you would get Disney's channels, which would obviously include all the Disney channels, but also ESPN. They also have an interest in A&E and several other networks. So all of those channels basically would have payments that would go to Disney. Disney would also profit on the advertising revenues whenever you watch a particular channel. They sell those advertising spots to different advertisers, and that's another stream of revenue that they get from that. However, people have started to cut the cord, so to speak, on cable, and that's already been a pretty widely covered topic. Everyone knows about it at this point. Less and less people are subscribing to cable and turning instead to streaming. And this has also had a profound impact on Disney. They are attempting to transition away from what they call linear networks division, which is basically their traditional cable business, advertising, that sort of thing, and instead move towards this direct-to-consumer segment, which is Disney Plus, ESPN Plus, and their ownership, part ownership in Hulu. So if you just take a look at the revenues, you can see that the direct-to-consumer business is increasing at a substantial pace. So a 55% increase in revenues from 2020 to 2021. However, the linear networks and then the content licensing are both either stagnant, so linear networks were up 2%, meanwhile content sales and licensing was down 33%. So the total revenue increases for this division was only 5%, but it's even worse when you take a look at the operating income. So the linear networks operating income declined by 11%, and the content sales licensing declined by 51%. And then here is the major kicker: the direct-to-consumer operating income has improved, but it's improved from a less negative number. So in 2020, the division lost nearly $3 billion. In 2021, the division lost over $1.5 billion. And the news for this particular segment got even worse in Q3 2022. Disney reported their results, and it was an ugly quarter. For the year ended October 1st, 2022, the direct-to-consumer business lost over $4 billion. Nearly $1.5 billion came in the October 2022 quarter. Despite impressive subscriber gains, the market is clearly saying to these streaming companies, look, we don't care how many subscribers you have, we want to see profits and we want to see it now. While the media division does continue to struggle, it's really encouraging to see that the Disney parks has basically recovered back to their 2019 profit levels. For the 12 months ending October 2022, that division made over $7.7 billion in operating profit. That makes Disney very difficult to value. On the one side, you have a division that just recovered back to its prior profitability, and on the other hand, you have a division that is struggling mightily, losing a traditional form of income while adding a new one that is currently very unprofitable. So how do we value Disney? Well, I'm going to give it a shot. So the question we're trying to answer is Disney undervalued? Right now it's trading at about $92 per share. To calculate what Disney is worth, I'm going to look ahead 5 years and I'm going to attempt to project the earnings. And whatever earnings I get, I'm going to multiply those projected earnings by a PE ratio. And I've got different ranges of PE because I think this is the trickiest part to estimate. So we're going to use kind of a super bearish 7.6. This is what they traded at in March of 2009. Then I'm going to use a no growth PE, which is simply just took 1 divided by the current 10-year treasury of 4% and added a risk premium of 5%, which gets me a PE of 11. Basically, this would be, I think, what you would pay right now for a stock that had 0% growth. Then I'm going to look at a PE of 16, which has been the S&P 500's long-term average. And then the more reasonable PE, I think, would be 22. This is what Disney has traded at on average over the last 20 years. And then I think the highest PE you could reasonably expect would be 29.4. That's what it traded at, kind of, if you look before this earnings depression from the parks segment. I think this would be a pretty bullish outcome if we got that PE in 5 years. So this will create a range of potential stock prices that Disney could be trading at, and then I'm going to back out to see how much would we make on the stock if it traded at each of these prices, backed out to kind of an annualized return. So here are just some assumptions and what I think is a fairly reasonable scenario. So the Disney Parks division operating income was about 7.7 billion over the last 12 months. Let's say that this grows operating income by 5% annually. Obviously, this assumes you probably don't have a global recession, since this is mostly people going on vacations, right? So this is going to grow at 5% per year. We're going to assume the direct-to-consumer losses continue until the year 2024, and then afterwards, we're going to assume those profits go up by 1.5 billion. We're going to assume their traditional distribution network declines at 15% annually. Just for reference, the linear networks actually declined by 11% in 2021. So this could be a little bit of a sharper decline than we've seen so far. I'm going to use the interest payments per the 2021 10K. They give a schedule on what their current interest payments would be, assuming no increase or decrease in debt. I'm going to use an income tax rate of 21%. They've actually had a pretty stable rate over the last 3 years. And then the shares outstanding, I'm going to use the current number, including all dilution from options, that sort of thing. They currently have 1.8 roughly million shares outstanding. So if we plug all of this into Excel, here's what we come up with, right? So 2021, this is kind of where we're at right now. The Disney Parks division at 7.7 billion is going to increase at 5% per year, which means in 2026, we're expecting that division will make $9.4 billion. The direct-to-consumer, currently losing $4 billion, ouch, that's going to improve to a loss of 1.5 billion in 2023, and then a break even in 2024. And then after that, we're going to assume that they increase and actually become profitable, adding 1.5 billion per year. And then, like I said, the linear networks, we're assuming a negative 15% growth rate, I guess, shrink rate, whatever. So that's going to decline until 2026. It'll be basically half of what it is today. So when you add all of this up at 2026, we're assuming operating income for Disney at 16.7 billion. I'm going to subtract the interest payments that they show on the 10K, would get us to an earnings before tax of about 15 billion. If we take that and subtract out the 21% they would owe in taxes, that gets us to a net income of $11.9 billion. Of course, we can just simply divide that by the shares outstanding, and it would get us to an earnings per share number of $6.50. So now let's say if Disney were to earn $6.50 in 2026, what would their price be? Well, we can simply take that $6.50 and multiply it by some number, and that will get us a price projection. So looking at this column, this 2026 column, this is the estimated price that Disney stock would trade at if it earned $6.50. So the absolute low, assuming, would be a low of $49. I think that's probably highly unlikely unless you have a repeat of 0809. So I think if you saw a $50 price tag on Disney, you would be definitely a buyer at that point for sure. But a no growth PE, I think, again, this is pretty conservative. That would be a price target of $71. Again, I don't think that's very likely, specifically for a business like Disney. If that's what happened, you would lose basically 4.9% per year. That's what this CAGR column is. It's what's the 5-year basically return if you were to invest in the stock, and it would do this. This assumes no dividend since they don't pay a dividend yet. I suspect they probably will again at some point, but for now they don't. So we're just assuming nothing on that. Here's where we start to get, I think, a little bit more into reasonable territory. If they trade at 16 times earnings, which has been the S&P's long-term average, they'd be about $104. So you would make some money in that case, but only about 2.5% annually. And then if Disney would trade at their average PE that they've traded the last 20 years, the stock would be worth $143, which would be a compound annual growth rate of 9.2. And then we have a very optimistic scenario would be $191, and that would be a compound annual growth rate of 15.7. So when I look at this stock and I think about, okay, so if you can invest in Disney right now and make 9.2% per year, I think that's probably my most likely scenario. I would imagine that's somewhat close to what the overall market should produce over this time period. And I'm just judging that simply by taking the 4% US Treasury yield and adding a 5% risk premium, which is what you've historically gotten. So at this point, I think, relative to everything else, I think Disney is probably about fairly valued. The upside or downside really depends on this direct-to-consumer business and also on a recession. I think if you get a recession, you're going to get the parks revenue and income. That's going to decline. That could give you more downside pressure. And then really this direct-to-consumer business, I think the question is this division able to kind of take the baton from the traditional network that Disney has had? And are they able to kind of recreate themselves in this direct-to-consumer area? I think so far the streaming industry, at least in 2022, has been battered. The market is saying, look, we don't really care about subscribers. We want to see profits. So I have a feeling that Disney is going to get this turned in the right direction. I think that's a pretty high likelihood. The biggest question, though, is how are they going to be able to make this into an increasingly profitable enterprise? So since this really hinges on the direct-to-consumer business, let's take a look at some of the levers that they could pull to get this thing profitable. The first lever I think they're going to pull is obviously adding new users. That's what they've done so far, and they've done a pretty good job of that. They've started bundling ESPN Plus, Hulu, and Disney Plus into one, which I think has definitely helped. But I think the biggest lever they can pull is here, this higher prices. They announced that instead of having the ad-free level at $8 a month, they're going to now have $8 a month be an ad-supported level. So they're going to show some ads and get some revenue from that. And then they're also going to add an $11 ad-free level to Disney Plus. So let's just say that between these two levels, they can increase the amount of money they're getting per subscriber by $3 a month. And let's just say Disney actually ends up with about half of this, which is what they're getting right now. So Disney Plus costs $8 a month. You look at their revenue per subscriber, it's about $4. So they're getting about half of this increase. That would be $1.50, basically per month per user. So we can multiply that by 12, and that gets us an extra $18 per month per user. And the number of Disney Plus subscribers is currently 164 million. So you multiply 18 by 164, that would be a $3 billion increase in the amount of revenue that they're getting. And theoretically, this entire amount should go right to the bottom line. So just this alone would almost get the division profitable, or at least break even. The other thing, obviously, they can do is continue to add new revenue. That does come with a cost. So for every roughly dollar in additional revenue that the division has gotten, the costs increased by 80 cents, and that was from the 2020 to 2021 period. So just assuming that's the case, you do have some operating leverage here. So each new subscriber, assuming these economics would work out, each new subscriber is going to add about $13.20 to the bottom line. So they basically need another 75 million subscribers plus this in order to make Disney Plus break even. So let me know what you think in the comments down below. Do you think the direct-to-consumer division is going to be able to become profitable sooner than expected, making Disney a pretty good value right here? Or do you think the looming potential recession or the direct-to-consumer business are going to continue to struggle and lead Disney even lower? Let me know in the comment section down below what you think. And again, this is not a recommendation to buy or sell Disney. just hopefully giving you a little bit of an inside look into how you might think about Disney's different segments and how you might value the stock based on your particular outlook. So I hope that was helpful for you. If you're interested in more videos about valuation, I do have a valuation course that I'm currently building. You can sign up for the beta of that valuation course, which is going to be offered at a lower price than I eventually launched the course at. I'll put a link in the description below if you're interested in that. And if you're interested in these kind of deeper dive valuation businesses in a particular stock, let me know if you'd like to see more of this content in the future. And if so, put a stock in the description down below that you would like to see covered. Thanks for watching, and I will see you in the next video.